market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Israel's Prime Minister Benjamin Netanyahu has vowed to retaliate after Iran fired about 200 ballistic missiles at the country last night. Now, the barrage started only hours after the U.S. warned an attack was imminent. The Israeli army says many missiles have been intercepted, with reports one person was killed in the West Bank. So for more on all of this, let's get straight to Jumana Merseche, who's in the Middle East for us. Jumana, how does this Iran attack actually differ from the one we saw in April?
Yeah, it's a valid point to raise, Francine, because this is the second incident of a direct attack on Israel by Iran. The first one, of course, happening back in April of this year. And back then it was in reprisal to airstrikes on the Iranian consulate in Syria. Iran had threatened to retaliate. The retaliation did come in April. 300 drones were sent back then, all of them intercepted. And the interpretation at the time was that the reaction from Iran was mostly symbolic. Of course, you fast forward to today, and the reprisal comes on the back of the killing of some very important figureheads within this axis of resistance. They're responding to the killing of Ismail Haniyeh, who was the Hamas leader that was killed in Tehran, the killing of Hassan Nasrallah, killed last week in an airstrike alongside one of the senior IRGC commanders, also killed in the same airstrike that took out Hassan Nasrallah. So Iran had to be seen to be doing something. And of course, the reprisal did come in the last 24 hours. They sent up to 200 ballistic missiles. Now, the Israeli Defense Forces say that they intercepted pretty much all of these rockets that were fired. There was limited damage. There was reportedly one person who was killed, but is on back of shrapnel. But the key difference this time around is that it was less telegraphed. So there were only a couple of hours heads up that a strike may be imminent. And then also the types of missiles that were fired this time around, ballistic missiles. They were precision missiles. They were concentrated around military targets that were, Iran claimed, were used to launch the airstrikes that took out Hassan Nasrallah, in addition to being faster moving. And so it is somewhat of an escalation in terms of how Iran chose to respond to this form of reprisal.
Jumana, thank you so much for the terrific briefing. Jumana Merseche there in Dubai. Now let's also talk to Tina Fordham, founder of Geopolitical, Strategist and advisor at Fordham Global Foresight, and then we'll get the market reaction with Laura Cooper. Tina, thank you for joining us. I mean, this definitely feels like an escalation. Mark Champion, though, says it's a strategic error on the part of Iran because they tried to do as much might as they could, but it didn't really go anywhere. Would you agree with that assessment?
I just looked at Mark's piece. I mean, I also wrote that it was expected that Iran would have to retaliate. Israel keeps upping the ante and keeps exposing, really, Iran's vulnerabilities. But the way that we need to interpret the response is that it was significant, but it was focused on military targets. And it falls short, I think, of the threshold of triggering a wider war, and in that sense, it probably ticks the boxes that Tehran needed to, but they are on the back foot.
Do they? I mean, is there? Looking at this, does Iran want a real war, or was it a warning?
Iran has a different geostrategic calculus at the moment than Israel, and this is what I've been underscoring in my research. For Israel, they have a perceived window of opportunity to degrade the enemy, their adversaries, Hamas and Hezbollah, Iran's proxies, between now and U.S. elections in 5 weeks' time. It is not a remarkable insight to expect that Netanyahu would prefer a return of Trump to the White House. Whereas for Iran, their geostrategic calculus is quite different. They need to wait it out. It's not a secret that they would prefer a Harris White House, mainly because, and this is really important for your viewers, they would like to see a return of the P5+1 construct, the diplomatic construct. Yeah. So Iran needs to hold the line, not allow itself to be humiliated, and bide its time. With all of this in mind, though, this kind of missile, ping pong that's taking place between Israel and Iran's proxies isn't likely to die down. At the same time, though, the Saudis have increased their production targets, so oil supplies are higher. That's important too. Sorry.
But Tina, I mean, I know it's early reports, but, you know, a lot of the missiles that Iran fired were shot down. Some of them broke through Israel's air defense this time. What does Israel want at this point in time? They talk about retaliation. Are they going to go hard?
I think that Israel's response will similarly try to strike the balance between not allowing a serious attack from Tehran go unchecked, but without going further. Iran and Israel do not want to be in direct conflict. In that sense, they have shared objectives. But it is absolutely in Israel's interests, as it sees it, to do more to diminish the capacity of Hezbollah and Hamas. And taking out the leadership, the decapitation strike, as it is known, is dramatic and causes temporary kind of reduction in capacity, but it's not enough to curtail this risk. And we're heading to that October 7th anniversary, which will be a very somber and probably quite angry anniversary for Israel, and Netanyahu very much exposed for what he has done in the past year.
But Tina, if an Israeli missile strikes back at Iran, if, you know, what we've seen in the last couple of days continues in Lebanon and Iran fights back, I mean, are we going to see a disastrous war with potentially the U.S. drawn in? Like, who's going to really try and mediate this and bring this down?
Well, who's going to mediate it? That is there's nobody with the capacity to do that right now, and Biden saying consistently that it will back Israel almost no matter what, I think undermines U.S. moral authority on that front. But I put it slightly differently. I think as long as these volleys of missiles, serious and terrifying as they are, continue at this pace, going back to what Jumana said, markets won't respond. They're aimed at military targets. They haven't been very effective. I think symbolic is a poor choice of words, but that's what I hear from market participants. The thing to watch for will be if Israel targets Iran's energy infrastructure facilities, and that's a real risk. There's footage coming out of Iran of people, you know, filling up their petrol tanks. Do they know something that we don't know, or are they just being rational actors in a very volatile part of the world?
Tina, thank you so much, as always. Tina Fordham, founder, geopolitical strategist, and advisor at Fordham Global Foresight. Now, we can also speak with Laura Cooper, global investment strategist at Nuveen. Laura, always great to speak to you. It feels like a big market day, but actually the market is not really reacting it's reacting quite oddly. So we're seeing for the first time it move gold, a little bit oil, but again, it feels like it's at the margins.
Well, and I think that's really just markets' reaction to the escalation in geopolitics. We did see that flight to safety yesterday. Bonds were quite strongly bid. Gold was rallying again to record highs. But I think it speaks to the broader backdrop for markets, that these are markets rallying on the back of aggressive monetary stimulus or the expectations thereof and fairly resilient growth backdrops. And some of those could yet to be challenged if we were to see this escalations persist, or if we start to see, you know, inflationary pressures building and central banks don't actually follow through on some of those market expectations.
But, Laura, do you think that's right? I mean, markets seem to be, again, it's at the margins, and I know there was a movement yesterday, but looking through some of, you know, the geopolitics, when do they sit up and really take notice?
I mean, it really does depend on whether we see a broadening of the geopolitical tensions or whether we see a consistent kind of lengthening, or it may become more concerning. I think at this point, we're largely going to see knee-jerk reactions. And it really just adds to this view that we're going to see bouts of volatility in markets. We also have the U.S. election coming forward. And this does suggest to us that you have to have a very defensive and selective up-in-quality positioning in your portfolio allocations.
So where do you put oil at the moment? Is it range-bound? We also have a lot of shale, you know, that from the U.S. that's come on the market, which is a little bit different to what it was like 5-6 years ago.
Well, it's quite interesting because we're coming off where oil had quite a challenging quarter. We also have had Saudi Arabia coming out saying they're going to abandon their price target, which to our mind does suggest that the risks are tilted to the downside. But then you overlay that with geopolitical tensions, and we clearly are seeing oil as the pressure valve for that. So we're likely going to see more range-bound trading around that $75, $80 barrel mark until we see clarity from really both of those fronts, the supply side and as well what we're seeing from the geopolitics.
But diversification is the key. So we'll talk a little bit more. What do you buy in this market?
There's lots to buy. I mean, there's certainly, we're looking at a number of different exposures. Certainly, if we look at European government bonds, Japanese government bonds at the long end of the curve, even taking on some of those up in quality equities in the U.S., there's certainly opportunities despite kind of the volatility and despite the uncertainty that markets are facing.
Laura, thanks so much. As always, Laura Cooper, Nuveen's global investment strategist, stays with us. We'll talk a little bit more about those opportunities. And guess what? We'll also talk about French government bonds. Now, Nike shares have fallen pre-market after the sportswear giant withdrew full-year guidance. The company also reported a 10% fall in fiscal first quarter revenue, just short of average estimates. You can see Nike down 5%. Much more to come, and this is Bloomberg.
It's definitely too low. We are struggling to get positive growth this year. But the more fundamental problem is that we don't only have a cyclical growth issue, we also have a structural growth issue.
That was Jörg Kukies, the chief economic advisor to the Chancellor Olaf Scholz, speaking to us yesterday on the growth challenges that the German economy is facing. Meanwhile, the euro area's second biggest economy is wrestling to tackle its budget deficit. Now, the new French Prime Minister Michel Barnier has delayed a target to meet the EU's budget deficit limit by 2 years. Well, let's return to Laura Cooper, Nuveen's global investment strategy. Laura, a lot of people have a lot of sympathy for France. He needs to balance the books. He has a very thin majority, and he needs to do something. But as an investor, does it make sense buying French bonds?
Well, at this point, no. We think there's the political risk premium that's actually baked into French, particularly the 10-year, is warranted. We could see some kind of closure of that boon to oat spread, but even then, only about 60 to 70 basis points. I think it's currently about 75 basis points. Because if we look at kind of what some of the comments were yesterday, yes, they expect the deficit to come at 5% next year, but 2/3 of that expenditure will come from actual spending cuts, and the other 1/3 will come from taxes. But there's a lack of detail in how they're actually going to achieve that. And then throw in the fact that there's likely going to be an election, let's say in the next year or so, and there's too much political uncertainty. So we think, in the near term, we're slightly trimming our underweight to French government bonds, but really the structural challenges preclude us from actually going overweight.
Laura, when you look at Germany, it's also not doing great. Is there anything that you would buy up in Europe right now?
Well, I think if anything, the German backdrop, yes, has been challenging for quite some time. We're seeing this kind of broad softness across the European economy. And Christine Lagarde, actually, her comments to European Parliament suggest that they're actually gaining more confidence that inflation could return to their 2% target in a timely manner. So on the back of that, we actually expect the ECB to cut in October and then have consecutive cuts. Now, the market is slightly, a little bit overly aggressive in terms of that, but we still think there's opportunities in taking German bond exposure as a safe haven. We clearly saw that bid yesterday. And then having some of that periphery exposure in EGBs, looking at Spain, Greece in particular, they've actually been strong outperformers. And then as well in the credit space, opportunities in European credit up in quality, particularly in the belly of the curve, is really where we're finding a great opportunity set right now.
Laura, I also want to ask you about the Fed, but this is what Larry Fink yesterday said about market pricing.
I think the forward curve is wrong. Okay. We're not going to see, and I think Chairman Powell said that yesterday. We're going to be patient as we. I think the amount of easing that's in the forward curve is crazy. I do believe there's room for easing more, but not as much as the forward curve would indicate.
There you go. The forward curve is crazy. What do you buy in U.S. Treasuries right now?
Well, I think the fact that the Fed pricing does look quite aggressive in our mind. We're anticipating, consecutive 25 basis point cuts through to next June, bringing terminal to about that 3.5% mark. So still kind of well above where the market anticipates. But we're going to see bouts of volatility. Fed Powell the other day said that this is data dependency, meeting by meeting. So we have the payrolls print on Friday. That, in our mind, is going to bring about bouts of volatility. So we're really playing the short end and the belly of the curve quite tactically to take advantage of that. that, and then staying overall neutral duration, because we think this is an environment where the curve can continue to steepen as we start to think about some of those election risks coming through.
Laura, we're going around the world in like 60 seconds, but the Bank of Japan, so we have, a new leader of the ruling party, but he's called an election of October 27th. I mean, this was the place where a lot of investors wanted to be. Are you taking a pause until we know the outcome of the election?
Well, we've been quite reluctant to actually have exposure to Japanese government bonds, with an exception. I think at this point, the Bank of Japan is going to remain exceptionally dovish. We don't anticipate the next hike really until December or January. But if we look at just how rapidly the JGB curve has steepened, we think there's actually opportunities looking at the ultra longs there. It really is more of kind of a geopolitical recession risk hedge. There's supply technicals that are quite favorable. So we think there is opportunity there. We don't think that we're going to see this kind of repatriation back to kind of the Japanese bond market. There's a number of factors. U.S. growth exceptionalism is still persisting. Ministry of Finance data still supports Japanese buyers kind of going to the U.S. Treasury market. So I think at this point, it's kind of a wait and see mode, but we really don't have strong conviction that now's the time to kind of reallocate to Japan bonds in particular.
And it doesn't change depending on who's in the White House after November 5th.
I think ultimately fundamentals will continue to drive. It's really just about being very selective. We're going to see pockets of sectoral performance diverge in terms of U.S. equities, but I think at this point, it's really it just contributes to the uncertainty that markets are facing, which does suggest more volatility ahead.
Laura, thank you so much, as always, for joining us. Laura Cooper, there, Nuveen's global investment strategist. Now, coming up, Tim Walz and J.D. Vance go head-to-head in the only vice presidential debate before the U.S. election. Was there a knockout blow? We'll be live in New York next, and this is Bloomberg. Well, Tim Walz and J.D. Vance have gone head-to-head in what's likely to be the only vice presidential debate before the U.S. election in 5 weeks' time. Now, there was a shaky start for Tim Walz as he stumbled early on, but there were no knockout blows. Well, sparring points included immigration and whether Donald Trump lost the 2020 election.
Donald Trump's inability to say, he is still saying he didn't lose the election. I would just ask that. Did he lose the 2020 election?
Tim, I'm focused on the future. Did Kamala Harris censor Americans from speaking their mind in the wake of the 2020 COVID situation?
That is a damning non-answer.
Now let's bring in Bloomberg's Vonnie Quinn, who joins us from New York. Vonnie, so happy to have you on. What were your main takeaways from the debate?
Well, Francine, that part that you just pointed to there, that was probably the most combative part of the night. It was essentially a very convivial almost debate, a traditional type of debate in a sense. We had obviously all of the potential things that could have gone wrong in our heads. Were the candidates going to prove that they were the right choices for each of the top of the ticket candidates? Were they going to make any kind of trouble for their candidates? And would we learn anything new on policy or about the candidates? I think it's fair to say that they passed all the tests, or at least they didn't fail them. And with just 34 days until election day, anything has the potential to make or break a candidate, to sway a potential voter, right? The only new thing we got on policy was actually from outside the debate. Donald Trump was obviously watching the debate, and when it came to reproductive rights, he ended up putting on social media that he would veto any ban on national abortion that came across his desk. That was a big change from the presidential debate, where he said he wouldn't sign one because it wouldn't come to that. So that was interesting. J.D. Vance's big complaint was that Kamala Harris has been in the administration for 3.5 years, and so anything she says she's going to do, she should have already done. But that's a complaint we've heard lots before. So on to the swing states for more, Francine.
Vonnie, thank you so much. Vonnie Quinn there in New York. Now, coming up, iron ore and metals spike on China's stimulus measures. We'll discuss that and much more with Rick Deverell, chief economist and head of net zero at Macquarie. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Well, Israel vows to retaliate after Iran fires about 200 ballistic missiles that were largely intercepted, saying Tehran made a big mistake. Traders flock to haven assets, with gold holding near a record, but Chinese stocks surge in Hong Kong on stimulus bets. Plus, the Prime Minister, Michel Barnier, delays plans for France to meet its budget deficit target while outlining plans for spending cuts and tax hikes. So Israel's Prime Minister Benjamin Netanyahu has vowed to retaliate after Iran fired about 200 ballistic missiles at the country last night. Now, the barrage started only hours after the U.S. warned an attack was imminent. Now, the Israeli army says many missiles have been intercepted, with reports one person was killed in the West Bank.
Iran made a big mistake tonight, and it will pay for it. The regime in Iran does not understand our determination to defend ourselves and our determination to retaliate against our enemies.
The Revolutionary Guard and Iran's armed forces are ready both defensively and offensively to repeat this operation with multiplied intensity.
Now, oil has extended its gains after Iran's attack. With us now, Will Kennedy, Bloomberg senior executive editor for energy and commodities. Well, how much higher can the price of oil actually go? I know it's reflecting this renewed risk premium, but actually it hasn't really gone off the rails.
No, it hasn't gone off the rails, but I think the move that we've seen since the attack last night is significant in that it jumped 5%, and importantly, it's held those gains. So I think that it is a signal that traders are recalibrating the risks in the oil market of this widening conflict in the Middle East. But you're right to say that the upside probably is capped. And one of the reasons that that is the case is because the OPEC at the moment has a significant amount of spare capacity. Saudi Arabia, especially in the UAE, could, if we see extreme scenarios play out which disrupt the flow of oil out of Iran, potentially replace those barrels. So the overall market picture is not especially tight, and I think that means that while traders are very alive to the increased risks after yesterday's events, it isn't going to get out of hand.
I was going to ask you, do you think this is going to be short-lived because of, I guess, the risk that's fading of, as you say, these supply disruptions?
Well, I think right now the market is going to be very alive to whatever happens in terms of Israeli retaliation. Clearly, everyone is braced for significant reaction from Israel's armed forces, more so than when we saw a similar cycle in April. And I think one concern is that we don't know what the Israelis are going to target, but one possibility would be oil installations. That would clearly hurt the Iranian economy and be a serious way to respond. And while we absolutely don't know if that's going to be the case, it is a risk that traders are prepared for. So I think we may see some tension in the market until the Israeli response becomes clearer.
I mean, again, if there is an attack on Iran's military infrastructure or oil industry, what does a sustained rally in the price of oil actually look like? Is it impossible to tell?
It's very hard to say. And, of course, the market is coming from quite a bearish place. We've seen some very bearish market positioning in recent weeks, mainly because of gloom about the Chinese economy. Now, sentiment seems to be turning around on China, and you combine that with a deteriorating situation in the Middle East and a risk to a much wider war, and I think we could see significant upside from here, but I'm not going to be confident enough to put a number on that for you, Francine, I'm afraid.
Oh, well, thank you so much, as always, for your terrific briefing. Will Kennedy there in charge of all of our oil coverage. Now, iron ore prices have surged to a near 3-month high after China eased home buying rules as part of a wider measures to boost the world's second largest economy. Well, joining us for more on all of this, I'm pleased to welcome Rick Deverell, Chief Economist and Head of Net Zero at Macquarie. Rick, as always, thanks so much for joining us. It's been a while since we've seen you on Bloomberg TV, so it's a treat. I mean, it feels like the world is very uncertain. It feels like the global economy was okay. Markets are okay largely because of, expectations of Fed cuts. But what do you do with geopolitics, and how will that permeate through the global economy?
Yeah, I mean, it is interesting in that if you look at the last couple of years, we've had some really big economic shocks. We obviously had COVID, we had inflation, we had the energy shock in Europe. And global growth's been much more resilient than a lot of people, including myself, had feared that it would be. So the starting point, I think, is one of resilience. But of course, there's always the geopolitical issues, and they're very much in focus now. The main impact from geopolitics normally comes through the oil market. So unless you get a disruption in oil, it will be a volatility driver. Clearly, we're seeing some risk premium coming to oil markets. But unless you get a physical disruption, the impact on the global economy is probably less than a lot of people would think.
Rick, why do you think actually overall the global economy has been a little bit better than expected? Again, we were kind of talking in the newsroom that we had lower oil price than expected. I don't know whether over the last 8 months that was almost like a natural stimulus for the world economy, plus all the fiscal stimulus that we had also during COVID.
Yeah, so again, I think we came out of COVID much better than people had feared.
Yeah.
Particularly the services sector has been very strong. And I think the fiscal stimulus was part of that, and certainly there was excess savings and people had a lot of money in the bank to spend. I think the oil price has been a bit of it, but it's not actually the biggest component. And particularly with the United States economy, the perversity now is because the US is now the biggest oil provider, most of the increase in global oil supply in the past 15 years has come from the United States. You could argue that a higher oil price is actually good for the US economy. It hurts the consumer, but it boosts business investment. So,
should we worry about debt levels more?
In the US, I'm not terribly worried about the debt levels. I do worry about the level of the deficit. Okay. So when you've got an economy that's at full employment still running a deficit near 7% of GDP, that's historically unprecedented. That's never happened in the United States before. But because it is the US, they've been doing this for a long time, so it's not an imminent threat, but it does raise risks as we move forward.
Do you worry about a U.S. recession? I know everybody talks about soft landing, which in my mind, I'm not exactly sure what that means yet. But it seems, France is certainly going through a rough patch. Germany is even going through a rougher patch. And many question marks about the U.S. economy.
Yeah, so I think Europe is different, and we can talk about that in a moment.
Worse?
Worse,
yeah.
Definitely worse. Again, the US has been remarkable in that we've had this big increase in interest rates. They're still growing above trend. And even though the labour market is softening, it's softening from a stronger point of view. And of course, inflation has come back down towards where the Fed would like it to be, so the Fed is easing. Monetary policy is still restrictive. What happens with Fed policy will depend on what happens with the economy, because they don't really know what neutral is. But you put all of that together and the probability that you have probably a no landing, not even a soft landing, is looking pretty good still.
When you look at, the race to net zero, I don't know whether we're in a hiatus, whether it's stopped because of the politics, or whether, private companies are slowly just continuing to go at it. It's just not really talked about as it was 2 years ago.
Yeah, so again, it's actually interesting in that there's a lot of discussion, of course, about the IRA and policies in Europe. The really big one at the moment is actually China. So China contributed 3/4 of the increase in global emissions over the past decade. And China is doing enormous things at the moment. So last year, China installed 290 gigawatts of new clean energy capacity. To put that in context, the United States installed 40. So it is interesting in that, yes, there are challenges. The politics has become more difficult in the West. But in China, they're making very large gains. But we need to keep it in context in that global emissions are still going up. They're going up at a slower pace, which just means it's going to take time.
What does that mean for some of your, some of how long it takes for example, technologies to take hold? Does it take longer than expected, or does it slow down and then accelerate again?
Yeah, so I think the political will is still there, and certainly at a corporate level, every corporate in the world would like to invest in this space. So I'm optimistic that technology will continue to improve. But what I say to clients is we need to focus more on the solutions. We need to focus on decarbonising. We need to focus on building renewable energy capacity and storage. And once we do that, and once we have those clean electrons, the fossil fuels will go away. So we need to keep focused on that. I think the incentives are in place. There are really good things happening. It's just that fossil fuels are such a big part of the energy system and the global economy. You can't turn it off quickly. So I just think it's a process and it will take some time.
But it's also, does it mean that as an investor you have to accept lower returns? And does a lot of this depend actually on who's in the White House come January 20th of next year?
So I don't think investors will accept lower returns. So I think government will have to find ways to incentivise investment and ensure that people get paid for making this investment. And that is happening. That's what the IRA was about. Obviously, China's doing it a lot on their own balance sheet. But I think that will be the process, because ultimately, yes, there will be some investors who will take a lower return, but across the board, I think it's unrealistic to expect private capital to fund this if they're not going to make the same return.
There's a big vote, of course, on Friday on the possible tariffs that the EU would impose on China EVs. I caught up with the main advisor to the German Chancellor yesterday in Berlin, and he was pretty tight-lipped. He says, look, we haven't made up our mind. I mean, is there a conciliatory way where actually China can do something on their end so they don't have to have extra tariffs, but they give less subsidies to some of these car makers.
They could, and that would be a good outcome. But I think this, for Europe, I think this is a really challenging issue, because obviously countries like countries like Germany, the auto industry is a very big part of their manufacturing base, and China is clearly out-competing them at the moment. We can debate how much that is subsidy-driven. China's exports of autos have gone from something like 1 million 3 years ago to 7 million in annualised terms now. And during that time, global auto sales have fallen, and of course Germany has lost market share. So it's not surprising that the politics is getting more difficult. The problem for Germany, of course, is that their biggest market is actually China. So any of the big marquee producers in Germany, their biggest market is China. So if China was to retaliate, that would be really bad for Europe as well. So it's actually a very difficult political issue.
Will they retaliate? I mean, China, I feel, has domestic issues. So is now the right time? They're already in a trade war with the US. Will they also try and get the Europeans angry?
So it's hard to say, but at the margin, I suspect there will be some retaliation. I think it's unlikely they would take it completely lying down. But as I say, it's actually a very difficult one. And remember, if you talk about global EVs, which where a lot of this conversation goes, growth has stalled in Europe, whereas China is still growing very strongly. So 50% of car sales in China are now EVs. So again, there's a big structural gap opening up in these markets, and it's going to be really challenging politics to deal with that.
Rick, thank you so much for joining us today. Rick Deverell there. Don't be a stranger. Come back very soon. The Chief Economist and Head of Net Zero at Macquarie. Now, coming up, diversifying from offices to retail, leisure and residential. We'll discuss the future of Canary Wharf with the group's Chief Executive, Shobi. That's next, and this is Bloomberg. Now, welcome back. Sentiment around the European office market has improved this year, but challenges remain for London's Canary Wharf Group. Now, it was recently downgraded by Fitch over short-term refinance, risks and cash flow constraints. Yet there was a show of commitment from shareholders Brookfield and Qatar last year, who also injected £300 million into the campus as it seeks to reinvent itself as a mixed-use neighbourhood. Well, I'm delighted to be joined by the Chief Executive of Canary Wharf Group, Shobi. Shobi, thank you so much for joining us. I mean, you've been working at this to making this really to attract more life sciences companies, to diversify away from finance, to make it a more exciting, neighbourhood in London. How's it gone so far?
The evolution has really taken off. We started this over 9 years ago in terms of bringing in the residential community. And in the last several years, we've not only added huge biodiversity investments, but made tons of amenities. And to your point, we've started construction on Europe's largest laboratory building.
Yeah, I mean, when you look at, North Quay, some of the things that's going on there, I mean, there's like a space that's like 820,000 square feet, and you didn't have a single occupant. So it must give you, like, hope that people will come to actually inhabit it and rent it and make good use of it.
Absolutely. I mean, I think Canary Wharf already is home to a burgeoning life science ecosystem. MHN, the regulatory version of the FDA is there. UK health security agencies there, and 2 years ago we opened 40,000 square feet of wet lab space, and that's all leased up. In the last year, we've leased over approximately 100,000 square feet of wet lab space. So the demand is there, and I think, as you know, London just does not have quality lab space in scale.
Do you worry about pricing? Is it, what will attract people there instead of around where Google campus is? I know you also launched Eden Dock, which is this new urban oasis. What do the tenants want to move to Canary Wharf?
In addition to having great space, it's about the place. And so having great connectivity, the site that you reference is right next to the Elizabeth Line station. So connectivity is key. We've got a host of bars and restaurants. And I think most importantly, from Canary Wharf Group's scale, we can provide housing for these corporates that want to be here, access to Heathrow City Airport. I mean, our marketing tagline is "It's all here," and so we're providing a whole ecosystem for those companies that want to be there.
But Shobi, was it harder than you thought? I mean, I know there's also, you've released initial plans for the overhaul of HSBC's tower. I mean, this is no small feature. When is the planning application actually due to be submitted, and how are you transforming the space?
We're on target to submit planning next September, and the idea is be ready to go in late 2027. And, we've got supportive shareholders in QIA that own that asset. They're involved in the whole One Planet sustainability efforts. And it's great to have them, at the lead of transforming what was a single asset into a multi-use asset.
So I have it on Good Company that this is also where a lot of the young kids like to hang out. But again, the numbers don't necessarily always reflect this kind of new regeneration project. You have about £350 million of bonds maturing in April.
Right.
What do you plan to do there?
We've got a tremendous retail portfolio. And to your point about the numbers, we had 67 million people visiting Canary Wharf last year in our retail centers. This year, we're going to surpass 70 million. So the demand is there, the vibrancy is there, and I think we're in the market right now with our retail portfolio, which I think we'll use to raise financing to pay off the bonds.
So will it get easier? Have you been held back by regulation? Do you feel what's your biggest frustration right now about?
Well, we joke preset. I mean, it's harder to do business in the UK than it is in the US. I think the government's working on planning reforms and all that stuff. It just takes a lot longer to get stuff done here.
So you wish you could have transformed Canary Wharf quicker? Is that a
Absolutely.
right way
well,
of saying it?
The Eden Dock that you referenced, that hopefully everyone can now visit, is officially open today, and it's really transforming how urban environments should be viewed and evolved so that they benefit both nature and humanity. That's taken over 3 years to get done.
Is there anything that you're looking to sell? Are there assets or things like that to kind of, again, shore up finances or to make sure that some of your backers are happy with your financial position?
No, I think Brookfield and QI are very supportive, as you referenced in the opening remarks. We're constantly in the market. Last year, we sold some affordable housing to CBRIM. We'll be constantly in the market, kind of looking where we can take advantage of either selling assets, bringing in joint venture partners, and growing Canary Wharf.
Yeah. Shobi, how have we changed, actually, the way we work and live since COVID? Have we underestimated the impact it's had on the workplace, or has it always been the same and you're just trying to match Canary Wharf to what people want?
I think people value the outdoors, and I think that's what we've done in terms of bringing nature and the blue and the green to Canary Wharf. But, if you and I had this conversation 4 years ago, people were saying the office is dead. The office is back. Our numbers are growing every week. The office is there. It's how we use the office and how we use the environment around the office in terms of amenities, restaurants, health clubs, that convenience factor. And it's been proven in terms of how nature benefits us in terms of our mental well-being, creativity, innovation. And so I think people want to be back in the office. It's how that office is created.
Paddle courts, why are they booked like 2 weeks in advance? Like it's harder to get a paddle court booking than it is to go to some of the top restaurants in London.
It's an amazing sport. We were very fortunate that we kind of got on that initiative 3 years ago. They celebrated their 1 year anniversary last year, and next time you come to Canary Wharf, I invite you to play a game of paddle.
Okay, who are our other two people?
We'll get them.
Okay.
No issues.
Open for applications. Shobi, thank you so much for joining us. Shobi Kandar, Chief Executive of Canary Wharf Group. Now, coming up, can a new chief executive do it for Nike? Shares fall in pre-market trading after disappointing first quarter revenue. We'll have the story next, and this is Bloomberg. Now, shares in Nike are lower in pre-market trading after sales missed estimates, and it withdrew its full-year sales guidance. Well, joining us now for all of this is consumer goods reporter Dasha Afanyaseva. Dasha, as always, thank you so much for joining us. So is this really the last of the bad news? It just seems to be coming thick and fast.
Absolutely. This is a typical thing for companies to do when your new CEO is coming in. Wipe the slate clean. Why should a new guy have to be beholden to the targets of his predecessor? But the problem with Nike is that they've already acknowledged that the changes they have to make will take a really long time. They have to rebuild relationships with retailers. They have to get a pipeline going of new innovations, and it's all quite tricky. And investors and analysts this morning and last night were saying the other dynamic is a new guy comes in, he has to increase promotional activity, potentially has to increase advertising spend, and that's not going to be great for margin. He potentially is going to bring in a whole new crew of people with him. All of that puts Nike in this kind of wait-and-see mode and helps explain why shares fell.
I mean, this is such a strong brand. You kind of wonder how we came to this. I mean, I know every time I go to one of the big shops, they just don't have the sizes. Are there any positive notes? Are there any quick fixes?
The positive note here has been China. It did decline 4%. But it was better than expected because, of course, the consumer goods sector, apparel and luxury in particular, has been very worried about that slowdown. So that's had a positive read across even for companies like Adidas and Anta. But Nike itself acknowledged that, we're not where we want to be even with that. The other point was they're very clear that they've neglected the runner. They've lost market share there, and they're putting a lot of effort into that. They're running shoes, models like Vomero 5 and Y2K grew fourfold in last year, but that's still not enough to compensate for declines elsewhere.
I mean, JD Sports also was under pressure today, or like Nike's problems contagious?
So JD Sports, there was a worry that Nike's problems would make it miss estimates, but that's not what happened. It even beat them slightly. But it just shows that this kind of malaise, this kind of downbeat mood about these big players and how quickly their market share can be eroded by upstarts like Hoka and On, shows that there's no rest for the wicked.
No rest for the wicked. There you go. Yeah, you're right. I mean, Hoka, there's the cool trainers that you see around the newsroom on the young producers. Dasha, thank you so much. Dasha Afanyaseva there with the very latest on Nike. Now, later today, the French President Emmanuel Macron will speak at a panel at the Berlin Global Dialogue with our very own Stephanie Flanders, Bloomberg's head of economics and government. Do not miss, of course, this great panel and interview. It's at 2:15 p.m. London time. Up next, Bloomberg Brief with Danny Berger and Manus Cranny in New York. A lot of the focus will be on global markets. A lot of the focus will be on what we're seeing in the Middle East as we watch for any kind of retaliation from this massive Iranian missile attack on the Israeli side. This is Bloomberg.